The Federal Reserve, often seen as a stoic guardian of the economy, made a surprising announcement shortly after Trump's victory. This announcement was unexpected and sent shockwaves through the financial world, catching many off guard. Led by Chairman Jerome Powell, the Fed decided to cut interest rates. This decision marked a significant shift in the central bank's policy, which had been characterized by a more cautious and measured approach in recent years. This move, a sharp departure from the cautious approach of recent years, signaled a belief that the economy needed a boost. The Fed's decision was based on a comprehensive analysis of various economic indicators, including employment rates, consumer spending, and global economic trends. The decision to cut rates was met with mixed reactions. Financial analysts and economists were divided in their opinions, with some praising the move as a necessary step to invigorate the economy, while others warned of potential negative consequences. Some lauded the move, arguing that it would stimulate investment and spur economic growth. Lower interest rates typically make borrowing cheaper, encouraging businesses to invest in new projects and consumers to spend more. Others expressed concern, fearing that it could fuel inflation and create a bubble in the stock and housing markets. These critics pointed to historical instances where low interest rates had led to unsustainable economic booms followed by severe downturns. The Fed's decision was a gamble, a calculated risk aimed at propelling the economy to new heights. By lowering interest rates, the central bank hoped to encourage borrowing and spending, which could lead to increased economic activity and job creation. It was a clear signal that the central bank was willing to take bold action to support growth, even if it meant courting controversy. The Fed's willingness to take such a decisive step demonstrated its commitment to steering the economy through uncertain times. The world watched closely, as the Fed's decision would have ripple effects across the global economy. International markets reacted swiftly, with stock prices fluctuating and currencies adjusting to the new economic landscape. Lower interest rates in the United States could influence central banks in other countries to follow suit, potentially leading to a global wave of monetary easing. This interconnectedness of global economies meant that the Fed's actions were not just a domestic issue, but a matter of international significance. As the effects of the rate cut began to unfold, economists and policymakers around the world continued to debate its long-term implications. Would this bold move by the Fed lead to sustained economic growth, or would it create new challenges that could destabilize the global economy? Only time would tell if the Federal Reserve's gamble would pay off. For now, the world remained on edge, watching and waiting to see how this bold move would shape the future of the global economy. The Dow Jones, the S&P 500, the Nasdaq, all major stock indices shot up like rockets after the Fed's announcement. The Federal Reserve's decision to lower interest rates sent a wave of optimism through the financial markets, igniting a surge that had traders and investors buzzing with excitement. It was a party on Wall Street, with investors popping champagne and celebrating what many saw as the beginning of a new bull market. The atmosphere was electric, reminiscent of the roaring 90s, as traders high-fived and cheered, confident that the Fed's move would inject new life into the economy. Lower interest rates mean cheaper borrowing for companies, making them more likely to invest and expand. Corporate executives were quick to seize the opportunity, reviewing financial reports and strategizing on how to leverage the lower rates to fuel growth. Factories buzzed with activity as businesses anticipated increased demand and ramped up production. This in turn translates to higher profits, which gets investors excited. Financial analysts were busy dissecting market trends, while investors eagerly watched stock charts, their excitement palpable as they anticipated a windfall of profits. Businessmen smiled as they reviewed their burgeoning portfolios, confident that the market's upward trajectory would continue. The stock market, often seen as a barometer of the economy's health, was clearly giving the thumbs up to the Fed's bold move. The green numbers flashing on digital displays were a testament to the market's approval, and investors outside the stock exchange building couldn't hide their enthusiasm, giving thumbs up to the cameras. The surge in stock prices wasn't just confined to the big players on Wall Street. Small investors too were caught up in the excitement, checking stock prices on their laptops and discussing potential gains over coffee. Financial advisors found themselves busier than ever, meeting with individual clients eager to capitalize on the market's momentum. Everyday Americans, many of whom have investments in the stock market through their retirement accounts, saw their portfolios swell in value. Middle-aged couples reviewed their retirement portfolios with newfound optimism, while families celebrated the increase in their savings, hopeful that the market's rise would secure their financial future. The stock market rally, if sustained, had the potential to boost consumer confidence and further fuel economic growth. Shoppers thronged busy malls and restaurants buzzed with activity as the wealth effect from rising stock prices encouraged spending. Consumer electronics stores saw a surge in customers, eager to splurge on the latest gadgets. However, some analysts cautioned against excessive optimism, warning that the market's exuberance could be short-lived. Concerns about volatility loomed large, with stock analysts expressing caution. Business news anchors discussed the potential risks, reminding viewers that the market's rapid rise could be followed by an equally swift downturn. They pointed to the fact that the global economy was still facing headwinds, such as trade tensions and geopolitical uncertainty, which could dampen growth prospects. International trade shifts in ports highlighted ongoing trade tensions, while mixed signals from stock market indices underscored the uncertainty. Financial analysts pointed to geopolitical hotspots on world maps, emphasizing that these factors could pose significant challenges to sustained economic growth. While the stock market celebrated, a different story was unfolding in the real estate sector. The combination of a strong economy, low interest rates, and limited housing supply led to a surge in demand for homes. Prices soared, making the dream of homeownership more elusive for many Americans. The housing market, much like the stock market, is driven by supply and demand. When demand outstrips supply, prices go up. The Fed's decision to cut interest rates further fueled demand by making mortgages more affordable. The rise in home prices was particularly acute in major metropolitan areas, where job growth and population growth were strong. For many millennials and first-time homebuyers, the prospect of owning a home seemed increasingly out of reach. The soaring cost of housing had social implications as well, potentially exacerbating inequality and putting pressure on renters, who faced rising rents as landlords passed on the higher costs. The housing market, once a symbol of the American dream, was becoming a source of stress and anxiety for many.